And a record close for the S&P 500 and NASDAQ. I want to talk about markets right now. Joining us right now is Gabriela Santos, global market strategist at JP Morgan Asset Management. We got Sam Stovall, chief investment strategist at CFRA. Good morning.
Morning.
To both of you.
Morning.
We've got, what, we got 2 weeks left? 2 weeks?
2 weeks, basically.
2 weeks. So can we speak about sort of the should we care about the technicals of the last 2 weeks of the year, or is that sort of an irrelevancy in terms of how you actually think? And I know that's such a short-term way to be, but I know that there are people. Look, I actually was just having this conversation yesterday with somebody who was saying, do I want to put any money to work in these last 2 weeks because they have a little bit of money on the sideline? Someone is actually talking about a bonus. There's stuff happening. And so the question is sort of, what are you supposed to do in the moment? What do you say?
So we've been talking to a lot of our clients who've had a really great year, and frankly, a really great 10 years, about taking the time to actually right-size a little bit here towards the end of the year, right? To make sure that we're going...
sell, lighten up the load?
If it has gotten a little bit over your allocation that you would like to have. So going into 2020, we think it makes sense to be a little bit overweight equities, but maybe with the recent run, you've gotten a little bit too overweight the equity piece. So take the moment to look, make sure you're positioned properly for 2020, and maybe that involves selling some of the winners. It's been a great year.
Where are you at?
Well, I think, technically you're getting confirmation from the small cap stocks that the larger ones having hit new highs are really justified, and that there is potential for longer term appreciation going forward. Remember last year we really did have a Santa Claus rally because the market advanced after it bottomed on Christmas Eve.
Okay, but if you look, so the VIX is at ridiculous lows. You have this view that the Fed is going to do nothing next year. There's part of me that would think to do the opposite, not to lighten up, but to say this is actually going to be better than people expect. Or do you think it's just so built into the case?
I think that's the problem, right? The good news is we have had a good year. The bad news is we've had a good year. And so valuation, especially for U.S. equities, already at 18 times. So as much as we can have a positive view on the fundamentals next year, which we do, the valuations are a little bit of a headwind to the returns that you can expect. And of course, the risks haven't completely gone away. So it is likely, of course, as always, to have moments of volatility and correction. And you want to be positioned appropriately for that.
Yeah, we've had pullbacks, 5 to 10% declines about every 9 months on average. And
we're still waiting for one, right?
With the PE ratio now, as Gabriela mentioned, at about 18.7. Remember back to January of a couple of years ago, we were at 19.3, and then we ended up having a pretty meaningful decline. But I think we have to really start to worry about interest rates, inflation, et cetera, for us to go deeper than 10%.
Okay, if you have to keep your money in U.S. equities, where do you want them then?
So this is a bit of an unpopular view, but we would have both value and growth. And this is really our focus, a little bit less in 2020.
Seems like you're getting it, you're having your cake and eating it too.
Let me explain. It's around this idea of a theme around income and focusing less on capital appreciation for next year, given that valuation's already at over 18 times, focusing more on total shareholder yield. What are the sectors that can give me a good dividend and buyback yield? And actually, you find them both in value and growth. You find them in financials and energy, and you find them in tech.
Are you looking for those that yield north of 3%, or are you happy with a more modest yield on that? Because there are some stocks that are yielding some pretty high.
So actually, if you combine dividends and buyback yield, you can look to financials and get a 7% yield.
Wow.
Yeah.
Which financials are you looking at?
So the large cap banks, And that includes the buybacks as well, That's a crucial component as well. But we also look at the energy sector, which has been completely left behind this year, shall we say.
And you think that's a value play?
And with a dividend yield of about 4%, that stable income stream, at least for 2020.
Okay, make this interesting. Tell me you disagree with her.
Well, I guess I can't really say I totally disagree with it.
It's already very interesting.
More interesting.
Thank you.
Sorry, Gab.
I appreciate it, Joe.
Okay.
No, but I'm just looking at the technicals for the value, S&P value over the market itself. It is turning around from a more than one standard deviation low. So we're above its 10-week, above its 40-week moving average. You're also looking at, I wouldn't be going for high yield, Becky, because take a look at...
Because there's a reason that it's high yield, right?
Oh, yeah. Also, I mean, utilities were trading at a 26% premium to their long-term absolute and relative PEs. So utilities, consumer staples, real estate have exhibited the glide path of a crowbar, mainly because investors are saying, okay, I don't really need to be driving into them because the Fed is on hold and I can probably find income elsewhere.
Gabriela, the financials, I think just in this past week, finally got back to the levels that they had seen in 2007, the highs that they had hit at that point. Does that tell you that there's more room to run? Does that tell you, okay, we've come a long way, we're finally back at those levels? If you're betting on it and thinking it's a 7% return, if you include the dividends and the buybacks, what does that tell you? Just the movement?
I think you can rely on that 7%, and then as sentiment continues to improve in 2020, maybe you get a little bit of a cherry on top with capital appreciation as well.
So you don't think we're headed towards a recession in the next year or longer?
We do not over 2020. We think we've established a soft landing here and can continue growing around 2% next year in the U.S. If we want something a little bit more high octane, more exciting,
give us.
Let's do it. Let's do it. More exciting.
More exciting.
I would be taking the opportunity to focus less on the U.S.
Right.
and let's get back into emerging markets, for example, right?
Okay.
Stability and global growth, less of a risk around trade. That's not really, the upside there is not for the U.S., right? The U.S. equity market, the upside there is for emerging markets, especially emerging Asia. So maybe take the opportunity to right-size the U.S. and focus more on some of the laggards like EM.
Sam?
I think international looks very good. Hate to not disagree, but my feeling is if you look at price performance on a trailing 12 or 60-month relative strength, the international markets are trading at more than a standard deviation below their mean, and it's not a value trap because if you look to S&P Capital IQ consensus estimates for the international marketplace, the PE ratios on a relative basis are also trading at an extreme low. So, the feeling is if you are a believer in reversion to the mean, I think this is an opportunity.